Welcome. Thank you all for coming. I'm excited to welcome you to our public forum on navigating economic uncertainty, perspectives from two former Kansas City Fed presidents. This event is brought to you by the Nebraska Bankers Association, the Higher College of Business, and the Menard Center for Economic Inquiry here at Creighton University. As Dean Henderson noted, I think this is a particularly timely panel as households recover from the worst bout of inflation we've seen in 40 years, and dealing with shocks to the job market. All of this has been sort of compounded recently by challenges to Federal Reserve independence and expanding fiscal deficits. And so we're excited to have three guests this evening that bring decades of unique experience in finance and monetary policy. Our panel will be moderated by Kyle Arganbright, the co-founder and president of Sandhills State Bank. In addition to serving as mayor of Valentine, Nebraska, and co-founder of the Bolo Brewing Company, beer company, he's on the board of directors of the Omaha branch of the Kansas City Federal Reserve. Our panelists, Dr. Thomas Hoenig, who's an Iowa native, has served the region for decades. I've served in various roles at the Federal Reserve System over a 30-year career. Most notably, he was president and CEO of the Kansas City Federal Reserve Bank from 1991 to 2011. And he is now a distinguished senior fellow at the Mercatus Center at George Mason University. Esther George is a Missouri native and also served the region in the Federal Reserve System over decades, including roles as the senior vice president of the bank's Division of Supervision and Risk Management, and from 2011 to 2023, president and CEO of the Kansas City Federal Reserve Bank. She is now chair of the Kauffman Foundation Board of Trustees. Throughout their careers, both of our panelists have bravely stood up for price stability and Federal Reserve independence. With that, please join me in welcoming our guests, Kyle Arganbright, Thomas Hoenig, and Esther George.
Thank you, Colin. It's an honor to share the stage with two small-town kids who've risen to become titans of industry and excellent public servants, so thank you for that. I think maybe for the benefit of the college students in the crowd, we could start with just a quick brief bio of maybe how you got to president and CEO of the Kansas City Fed. Esther?
I'll start. So I grew up on a farm in northwest Missouri. That's where I learned my initial lessons of economics, which had to do with the labor that I provided to the farm, what I got paid for that. But I was the first in my family to go to college. And when I graduated from college, my real focus was on I needed to also pay for a mortgage that was actually higher. It was 13.5%. But I answered an ad in the paper. This used to be how people found jobs. We had newspapers, look through to see where the jobs were. And I knew what the Federal Reserve was. And I thought it would be a place that would allow me to think about banking, because my summer jobs in school were in a bank, and would let me travel. And indeed it did. Tom was my boss, and I think one of my first travels was to put me in a station wagon and drive to Hays, Kansas to do a bank exam at the time. But what I found over the course of my some 40 years at the Federal Reserve was the opportunity to really see up front how the economy affected a broad swath of America, from banking to households to people that were looking to start businesses. And so the opportunities that I had at the Kansas City Fed were many, and ultimately led me to the job where I served on the Federal Open Market Committee and led the bank in a 7-state region that included the state of Nebraska.
Great story.
Thank you. Mine's a little different background. I went to college at one called Benedictine. Back then it was called St. Benedict's College in Kansas. And I majored in economics, and I loved it. I loved economics. It was unique. It was about choice and about how to think through issues. And I took some courses in macroeconomics and monetary policy and found it more fascinating. So I decided to follow that trek, and I went to work for the Federal Reserve Bank of Kansas City and did various things. I was in bank supervision before Esther, and then I was involved in research in that division and also finance, and very much enjoyed that. And that led, I was involved in a major banking crisis in the 1980s. In fact, literally hundreds of banks failed in this region, in Nebraska, Kansas, Oklahoma, Wyoming, and I learned a great deal from that. It wasn't a fun lesson, but it was a very valuable lesson in terms of uncertainty, in terms of risk, how you make choices in those conditions, and how you deal with tragedy, if you will. I then kind of became more involved in the policy areas and became president of the Federal Reserve Bank following that. And to the point where I was involved in the great financial crisis of 2007, 2008. And my experiences earlier taught me a lot about that crisis and how to deal with it. And so that was kind of a time of hard decisions and again, about choice. When I left the Fed, I then got involved with the Federal Deposit Insurance Corporation, became vice chairman of that. And again, many issues that surrounded that period following the great financial crisis. And so what I guess if I were giving you a lesson, it doesn't, come from different backgrounds, but the main thing is learning about how to deal with unexpected change, how to deal with uncertainty, and how to make hard choices. So that's hopefully part of the theme that we're going to have here today, and that Esther and I will share with you along with Kyle. So thank you very much.
So when I was leaving Valentine today, I had to get gas and supplies at the gas station, and my change was $1 with a J on it, which is Federal Reserve Bank of Kansas City, Missouri. Can you tell us a little bit about the Federal Reserve Bank structure, and specifically how Kansas City fits into it?
Yeah. Well, I'll start, and Tom, you fill in, because it is a structure that's not well understood, but I think really the design of this institution really came from the idea some 100 plus years ago that the American public does not trust concentrated power. And when the United States was putting together a central bank, it was very much on the minds of Congress that they needed to anchor this institution in a way that people could see that their issues were being addressed at a national level. Remember, this came out of a time when the farming community in particular, when there were booms and busts, found that they were not able to access bank credit. They were not able to get what they needed to sustain their operations. And so when Congress took up the issue of saying we need to have an institution whose job would be to think about economic stability, to think about price stability in the economy, it thought about a monolithic institution that would be centered in government, and it also thought about anchoring 12 regional Federal Reserve Banks across the country. So when you think about what was going on at the time, most of the population was in the Northeast. And so you will find that most of those 12 regional reserve banks ended up being in the eastern half of the country. And then you get to Kansas City, and further west, fewer of them. But the idea was that you would be able to put these regional banks in parts of the country where they could bring both a diversity of views about what is happening in those regions and bring that perspective to a discussion about how do we see the economy and how should the process of setting interest rates be put together. So it is a unique structure. I don't think you'll find this anywhere else in the world, and that's why I say it's really uniquely American in the sense of We like diversity of views. We want that institution to be responsive to what's happening at the local level, as well as making those important decisions nationally. And so you ended up with a regional bank in Kansas City. And a little piece of trivia here before I turn it over to Tom. That J on your money is because each of those 12 districts were numbered. And number 1 was in Boston, and you worked your way across the country. And Kansas City is number 10. And the 10th letter of the alphabet is J. And so we often referred to ourselves at the Kansas City Fed as 10J, because when the dollars are marked in terms of the allocation of the money across the country, they print it on there. So.
Yeah, the only thing I would add to that, to Esther's point, the Federal Reserve, as we have it now, is actually the third central bank of the United States. And the first was chartered in George Washington's time. It had a 20-year charter. It was very, very controversial because of the fear of centralized power and of the fear of financial interests against the rest of the country. At the end of that 20 years, it failed to be rechartered. It only had a 20-year charter, and it failed to be rechartered. And then about 3 years later, they went, because by losing that charter, there was all kinds of issues. We had a war with England. Financing was very difficult, so they rechartered a second bank of the United States. Again, 20-year charter. Again, very controversial. It passed by one vote, and it went on. And then we had the period of Andrew Jackson, that highlighted the difference between rural state banking, private banking, and the monolithic organization. And actually, it was Jackson who vetoed a rechartering of that bank because of the great dislike for centralized power. And then we didn't have another central bank for 80 years. And that's why when they rechartered it, it was very important to have decentralized central banking, because the first two had failed and they didn't want to take a chance. And so since then, there's been a lot of controversy with the back and forth between centralized power and decentralized power. And that issue is really with us again today. The whole issue of independence of the Fed is around centralized power, fear of Wall Street and Washington against the rest of America. So it continues on today.
Since we're talking about independence, let's just jump into it. There seems to be more talk of Fed independence now than I can remember in my professional life. Between public statements about Chairman Powell and the firing, which is being contested at the Supreme Court of Governor Lisa Cook, it's really ratcheted up. Will this political pressure lead to any steps that might improve Fed accountability if necessary, or could it more undermine the independence of the Fed?
So Tom, I think you're best. Can I just say ahead of that, let me describe the way the structure works when it comes to the decision making, and then talk about what that means for independence. So in this decentralized structure, there are 7 individuals that are named by the President of the United States and confirmed by Congress, and they serve at the Federal Reserve Board. That would be the public entity in Washington, D.C. And they are generally assigned 14-year terms. So it is a way for the public accountability to come into the agent. The 12 regional banks do not go through that confirmation process. So in the regional banks, you have a board of directors that is comprised of private citizens. 3 of them on the Kansas City Fed board are bankers, and the other 6 are people from the business community, from consumer entities, other parts of the economy. And it is their responsibility to select the president of those 12 regional banks. There are 12 of those boards. And so you have set up in this process an entity in Washington that have political appointments, and then you have 12 regional feds. And again, to this point about decentralizing, you create a sort of check and balance, if you will, within the organization that allows for independent views to come forward. You allow the insulation around the political process, around their terms being long. So the design of it extends to the people making decisions at the table. Tom, you were around when the Kansas City Fed wrote a book about under pressure, about political power, because what isn't new is that US presidents often do badger the Fed to have lower rates. So you might take it from there.
Well, the idea that the Fed is independent is perhaps overstated because it is a creature of Congress. It has responsibilities to the public, and that's well understood within the Fed. What you do have, though, as Esther said, there's a misperception that low interest rates are always good, even if it has unintended consequences like higher inflation that we're experiencing in the last few years. And so there's this constant battle, if you will, of politicians like low interest rates because it makes things seem stronger than they might otherwise be. And that goes on. And it's, like Esther says, it's not unique to this president. President Truman, well, actually, President Roosevelt interfered very much with the central bank. We actually went through a period where they pegged rates. Then President Truman, the Fed tried to reclaim its independence after World War II to set interest rates because inflation was rising constantly, and to get the inflation under control. And he was literally angry about it. He in fact invited, I put that in quotation marks, the FOMC, the committee that actually determines the interest rates of presidents and governors at the Federal Reserve Board. He invited them to the White House to have a discussion over that. And it was very bitter. In the end, there was a compromise that allowed the central bank, the Federal Reserve, to have greater independence in setting rates and printing money. All right, and we can talk about printing money in a moment. So that was done, and then President Johnson was president when he was expanding what was called the Great Society of support for the public welfare programs and fighting a war in Vietnam. And because of that, inflation started to rise again. And the Federal Reserve wanted to raise interest rates. And he literally called the chairman at that time, William McChesney Martin, to his ranch in Texas and scolded him physically to not raise interest rates. He needed to fight this war and continue on. And that was a major challenge to the Fed's independence. When President Nixon was going for re-election, he wanted to make sure the economy stayed strong. So he badgered the chairman then, a guy named Arthur Burns, to keep interest rates subdued. And we did get inflation. In fact, we got inflation over the next decade that was so high, it reached 14% and led to the financial crisis of the early 80s. So President Trump's efforts to shall we say, badger the Fed to lower interest rates is not new. It's not at all. But now this is a particularly important challenge because under this instance, the way the courts have ruled in the past is you could not fire a Federal Reserve Board member or a FOMC member without cause. And so this individual by the name of Lisa Cook has been accused of having misled on a loan application for a house, for a second house. And that is being used, and I don't know if it's correct or not, only the courts will decide that, but that's being called cause. And they wanted to fire her for that. The courts have said, no, you can't fire her yet because she hadn't been proven to be such. But if you could fire her, then the president would be able to name a new member of the committee, and that new member supposedly would be more obligated to the president, and independence would be challenged. So that is a major issue going on right now. We don't know how that's going to be resolved. We will find out, I think, soon. But in the meantime, there is this pressure on the Fed to lower interest rates. And they just did so in September, and the expectation is they'll do it again. Whether they will or not, no one knows. That adds to the uncertainty of our economy right now, and we'll see how that turns out. But if they're able to name their own, if the president is able to fire, then people are very concerned that the independence of the Federal Reserve to set policy will end. Thank you. And that's ahead of us now. So it's very controversial. It creates great uncertainty, and we'll have to see how it plays out.
So the Fed gets a lot of news and fanfare for monetary policy, but does a lot of other work. Esther, could you talk about the other functions of the Fed? It's maybe more of the blocking and tackling on a day-to-day basis that promotes financial stability.
Yeah, I mean, it's true. Obviously, a lot of the headlines are around what's happening with interest rates, but this is an institution that has been given responsibility, and most of those operational responsibilities are carried out in those 12 regional banks and their branch offices, including one here, right here in Omaha. In addition to monetary policy, the Fed was given responsibility for the supervision and regulation of financial institutions. And again, the country divided up across those 12 districts meant that a region like Kansas City, around those 4 states, had a large population of community banks compared to the New York Fed, which had mostly money center banks in their portfolio. And so it was a very diverse set of responsibilities for maintaining a pulse on the health of the banking system. And the reason that's important is because obviously when the Fed is setting interest rates, it affects the cost of borrowing. And so having the ability to see how is credit flowing through the economy was an important aspect of doing that. And on what terms? Was it fair lending? How was that being conducted? A third responsibility that the Fed has is for, and I'm going to use a broad term, of the payment system. When you and I are paying for things, we have the Federal Reserve, which really looks out for that through the banking system by and large. And when the banking system has not been able to fully provide for those services, the Fed is involved in that, because at the end of the day, when we all add up the outs and ends of the money across the country, it is the Federal Reserve Bank that is settling all of those payments. And so the Federal Reserve banks still handle billions of checks that run through that system. The direct deposit that you may have with a job that goes into your checking account. The Federal Reserve is increasingly involved in real-time payments. We know that the speed of payments is moving more quickly, and so the Federal Reserve is engaged in watching how large dollar payments as well as retail payments that you and I make are flowing through that system. So those functions all fit together, if you will, in terms of understanding how the economy is moving and how the economy is responding to different things, not just the interest rate, although clearly that's what central banks around the world do. They're all involved in doing that. The Fed has a bit broader mandate.
Since we have the former vice chairman of the FDIC here, I think supervision would be a fair topic.
Sure.
There's a number of agencies that supervise financial institutions in the United States. The FDIC, the Fed, the OCC, the NCUA. There's some conversation or some feeling, some people have feelings that maybe there are too many organizations that regulate financial institutions. Can you talk a little bit about that, Tom?
You're absolutely right. Number one, there are 3 agencies that supervise banks: the Federal Reserve, the control of the currency, which is in the Treasury, and the FDIC, which is separate, and it is an insurance corporation that insures deposits. So yours or your family's has a checking account in the local bank or large bank, it doesn't matter. Up to $250,000 is always insured, and this FDIC corporation looks at that. So because of that, they each have, they'll define it as a need to know how the institutions run, and that's the supervision part of it. Are they making good credits? Because if the bank makes a lot of bad credits, it fails, the payment system is interrupted, the economy is interrupted, and that's a bad outcome, obviously. And so they each feel a need to be involved in that. Now, the way they've structured that is the comptroller examines just nationally chartered banks, federally chartered banks. The FDIC examines state chartered banks, so different chartering authorities, different coverage. And the Federal Reserve charters state banks who choose to be members of the Federal Reserve and their ownership if it's a bank holding company. So you try and minimize the overlap, but it's still very confusing. That's, I think, important. Also, the Securities and Exchange Commission has oversight because of the largest banks who issue stock are publicly held. They're subject to SEC rules, so they have a role in fine. You said that the NCUA, which is the National Credit Union, these are institutions that make loans to individuals, take in deposits, and they are supervised. So you have these multiple, it's confusing, and some say, well, we can consolidate that. But every time you go to consolidate it, the issue comes up, well, how will the Federal Reserve know what's going on if they're just sitting there watching from the outside? And so it gets very involved, and they've been talking about consolidating for at least 100 years. So I don't know, I don't really think it's going to get done, but you never know. It could happen, and I think that's important. The main thing is, though, that so long as they divide responsibilities, it becomes less of a burden, although whenever you have different agencies involved, rules are written, you have to get them all to coordinate that, and becomes less efficient. And I think it's a matter of trade-offs, choice. Do you want a simpler system, a monolithic system, where you know where all the decisions are being made, or do you want diversified, where you have choices? And banks have historically chosen diversity, because if they get a really bad supervisor, they can change over time. We'll see how that plays out over the next 20 years or so as consolidation of the industry continues. At one time in this country, and not that many years ago, maybe 50 years ago, there were 18,000 banks and other credit unions operating. Now there's 4,000 banks, far fewer, and that consolidation continues. And then the issue of how many overseers do you really need will become even more pointed, I expect.
You know, I think one thing I would add to that, again, back to this issue of the American public really wanting to make sure there's checks on concentration. You have 50 states that charter banks. And historically, a dual banking system was designed to let states focus on what was unique, what would, foster growth in their area, as opposed to just, one national overlay. And I think that's something that gets missed in that conversation about, can't we just have one regulator? It's very popular in Washington. When you get out to the states, I think you find a lot more questions about, will you lose some of the things that are still important to this day that affect state economies and the things that they want to focus on?
So speaking of supervision and regulation, financial regulations were tightened after the 2007-2008 financial crisis. Do you think the problem of too big to fail was ever solved, and what did we learn from maybe a recent failure like Silicon Valley Bank?
Well, we did not solve too big to fail. And Tom, you've talked a lot about this, but I think we ended up codifying it. And what you saw in Silicon Valley was a sense that if I'm going to move my money anywhere, I'll move it to a bank that I think is not too big to fail. But you have written extensively on this, so you should answer this question.
Well, I would tell you, first of all, too big to fail, what is it? There are, in this country, institutions now, through consolidation, which are enormous. You take a JP Morgan Chase, you take a Wells Fargo, you take a Morgan Stanley, Citibank. They have trillions of dollars. JP Morgan Chase is over $4 trillion in size. It's very clear, and it was clear in the great financial crisis in the 2008, that if they were to fail, the economy would go into a freeze. We would have a major depression because they are the ones who are moving these trillions of dollars every day. They're making loans to corporations, and if they fail, the economy would freeze. So they're too big to fail, which also means, very important, that anyone who has a deposit, it doesn't matter if it's insured or not. So you have a deposit that's less than $250,000, it's insured. If you have a deposit of $2 million, it may not be insured. It probably isn't insured, unless it's in one of the banks that are too big to fail. Now, for community banks in Nebraska, Kansas, that's a huge competitive disadvantage, because where does the money leave if there's a scare? So let's talk about Silicon Valley for a minute. Silicon Valley was a bank that was, wasn't that large, relative to trillions. It was in the billions, and it was managed foolishly. It assumed that the government, that the Federal Reserve would never raise interest rates again, so they bought a lot of long-term debt, a lot of long-term assets, like long-term government assets, and then the Fed went and raised interest rates. Well, if you do that, if you hold a government security and you raise interest rates, the value of that security plummets, especially if it's longer term. So Silicon Valley had a fair amount of that on their books, and they raised interest rates, and people began to run. They said, well, it's going to fail. We don't know. They had to write down asset values. And then when that happened, they said, well, wait a minute. What about my bank? It's only $50 billion in size. It may fail. So they said, let's take it out of there. Let's move it to one of the too big to fail banks or to government securities. And so a crisis started to emerge. And lo and behold, suddenly banks that were regional banks were bailed out too, because you couldn't afford to have 100 banks of 50 billion to 100 billion fail. And so now people don't know for sure, is my bank too big to fail, or is it going to be bailed out? I don't know. And so we've created an uncertainty. And the main point of it is people always assume the largest are too big to fail. So they have 100% deposit insurance. Other banks do not. So now you have a movement underway. There's legislation in Congress today to cover all banks and up to 20 million, is it? Yeah, $20 million of insured. Well, that's fine. Now you've introduced a new problem. It's called moral hazard. If you do that, who really looks at the bank? Which analysts are saying, well, this bank is good and this bank isn't? Who's doing the discipline? No one. And so you get very undisciplined lending going on, and the opportunity for a new banking crisis. And that's what people are worried about, and that'll be the new issue in Congress around banking.
So I know the bankers in the room, we can talk about supervision all day, but we probably better shift a little bit. Let's talk about financial and innovation for the benefit of the college students. I'm sure there's a couple that have checked their Dogecoin price today. Stablecoin and cryptocurrency, there's been some question about whether or not that can enter the banking system. What are your general thoughts on that? Where are we along that timeline?
Well, there's a short answer and a long answer, so go ahead.
I take the short or long. So obviously, our financial system has been evolving and modernizing and innovating for a long time. I mean, think today about how we all use our phones compared to the days when, we had to go to a location to be able to get money or move money. So the evolution of our financial system has continued. And I think the most recent iteration of a technology called blockchain has led to creating what might a different kind of money look like. And we can debate whether it's really money or called currency or whatever, but the important thing is that when the general public begins to invest, begins to take their money and put it in these instruments, there's an expectation that it'll be safe, I'll be able to move it around, and we don't have the same framework around stable coins and cryptocurrency that we do, for example, around the banking system. It's a pretty well-worn, I think, framework to say, if I put a deposit in a bank, I have a savings there, I know how it goes in, I know who's watching it to make sure that when I want it out, I can get it. We are just making some initial attempts. Congress has just passed some legislation called the Genius Act to try to put some kind of framework around this new thing called stable coins, and to try to assure the public this will be okay because we're going to back it with a US Treasury. But this is a pretty new innovation, if you will, in terms of how it works both in good times and bad times, and how the values will unfold over time. And so I think this is a space today where I'd say, we have to be cautious because we don't know yet who's looking out for the public on this, how that framework will unfold. And as with any innovation, you tend to hear first about the upside, and only when something breaks do people look around and say, wait a minute, who was supposed to be looking out for that? So that's the risk right now.
And I would add the following. Okay, you want to make a distinction between cryptocurrency or bitcoins and stable coins. Bitcoin is a unsecured payments mechanism algorithm in which you are trusting that the system limits the amount of this new coin, this money, that can be created. And this is why it's become popular, because we've printed many, many dollars over the last 20 years. And that's led people to say, well, wait a minute, it's just not as reliable. So we're going to create this cryptocurrency that we can't print more of it than a certain algorithm will allow us. That will hold its value. And that's become a speculative currency. It's like gold. Because you say, well, if you can't print more of it and we're printing more dollars, the value goes up. So if you're going to get into cryptocurrency, you're speculating clearly on it holding its value or increasing in value. Stable coins are means of payment in which you create a token, but it's backed by government securities under the new rules. And therefore you think it's safe. But remember, it's backed by government securities. As long as there's government securities there, that's important. And the rule is you have to have it. Otherwise, you would be outside the law. But two things that I can tell you will happen. Number one, right now it's high quality assets backing it. There is a lobbying going on, and you can't pay interest on it. There's lobbying going on now to be able to pay interest. And I give you 100% guarantee that over time, there will be a movement to say we should have other high quality assets backing it. AAA rated securities should back it, not just government securities. That means you're increasing the risk. And as you increase the risk, you increase the possibilities of loss. And that will take place. Thus, you create a new kind of a currency system called stablecoin. And if it gets into trouble, who's going to back it up if it's not backed by government securities? So you're increasing your risk. And you have to be aware of that because you're all going to be approached by using stable coins. It's an easy payment mechanism, or Bitcoin. Make sure you understand what it is, because you can fool some of the people all the time, and all the people some of the time, but eventually there's a day of reckoning. Know where you are in that scenario. And that's the caution. It's fine to have it as long as you know what you have.
We do have a historic parallel to this, I think. We talked, as we talked about the Fed and other things, about how people don't like concentrated power. And when you hear the crypto industry say, we don't trust the government, that's fine. Some days I don't trust some of the things either. But here's what's important when it comes to your money. We've had a period in our country where we let banks issue their own money. And that issuance of their own money was sort of a decentralized way. But what happened when they got into trouble was it tended to feed on, everybody saying, is it my thing, the money that's not going to be worth what I thought? Is it not going to be accepted here? And I think we need to, a lot of regulation happened after that to say, how can we make sure that doesn't happen? We created a central bank to say, we'll intervene during those times of stress and liquidity. We don't have the parallel to that today. So again, maybe that will never happen with this, but if it does, we haven't really thought through the mechanisms by which the public will expect, I thought my money would be safe.
Yeah. I like to remind people there's nothing that's new in the world. If you think about a stable coin, the original issuance of notes, you backed them by gold. That was a stable coin, backed by gold rather than U.S. government securities. And so you went through that, and then you had crisis upon it as people lost confidence and they want their gold, and the gold wouldn't be there, so you'd have a crisis. So there's no new inventions. And that's my point to you. Make sure you know what you're buying. Caveat emptor, if you don't mind my saying so.
It's okay with Dr. Riley. We'll spend 5 minutes talking about monetary policy. Move to questions. Perfect. So since I'm sure many of you came from this piece, the Fed has a dual mandate, stable prices and full employment. Can you talk a little bit about what those targets are, how the FOMC kind of thinks about them, and just generally what you're seeing with, with immigration and tariffs and what effect that's having on some of those metrics?
Well, there are a lot of cross currents going on in our economy today, and I think all of you know that. Depending on where you get your sources of information, someone might say the economy's doing great, and others might say it looks like it's about to fall off the cliff. And part of that is because we're trying to judge with a lot of policy changes coming. We have new trade policies, we have new immigration approaches. Those are core elements in terms of how the U.S. economy responds to those. So, yeah, the Federal Reserve is asked by Congress, they're given a job to say, your job is to make sure that the nation has stable prices and at the same time, maximum employment. And so they call that a dual mandate. It means you have two things written into the law that the Fed is supposed to be accountable for. And so today, that's why you hear the Fed talking about how do we think the labor market's doing and how do we think inflation is moving. And we've come to a time now where the FOMC has decided our bigger concern is the labor market. And even though we haven't hit our target on inflation of 2%, we've kind of pushed that out. We'll get to that. It'll either come down on its own, but we'll focus here. And that, of course, as Tom mentioned, has led to this decision to begin again to cut interest rates into this environment. So the dual mandate really depends on low inflation, price stability over the long term, because you don't get good employment outcomes until you do that. So it is a debate right now within the committee about where they focus in the economy today. Are interest rates too high? Should we be cutting them? And of course, that gets into the whole debate about who wants lower rates versus keeping them where they are and tackling the inflation issue.
And I try and remind people on the FOMC, though they don't listen very carefully, but we've tried this before when we focused on employment as the we put it first. And that was in the 70s. And by the end of the 70s, the inflation in the United States had moved from less than 2% to 14%. It's not a free choice. When you emphasize employment and you say, we'll keep interest rates low so we can have maximum employment, you invite the inflation and you invite the pain for that. And they say, oh, yeah, but we were doing the right thing. And I said, no, you weren't. Because when you had that 14% inflation, to correct it, unemployment had to get to about 12%. It was tragic, the number of people, and the number of jobs lost, the number of farms in this region lost, the number of banks that failed. So it's not a free choice. It's a dangerous choice you make, I tell them. And I think that should never be lost. And I think that's one part of it. The second part of monetary policy issue today is that we run annual deficits in this country that are inexcusable. We have $2 trillion of new debt each year now, of new debt. And where does the money come from to lend that to the government? It comes from the public, but it also comes from the pressure then that's put on the central bank to print money. It is the only institution on earth that can create money out of nothing, literally out of nothing. When it buys a government securities under pressure, all right, not just to keep interest rates stable or low or whatever, but under pressure to finance the debt, okay? It creates money out of nothing. It prints money. And that stimulates and causes the inflation numbers to accelerate that we all have to pay for. And the Federal Reserve, because it's trying to protect its independence, doesn't talk about that, hasn't talked about it. But eventually they will have to, because the pressure now is going to grow to monetize the debt that's being created. And that's going to cause and worsen inflation. And that's the danger we face. And the uncertainty around that will only grow. And that's what I warn them, be very cautious about how much money you print.
Last quick question before questions from the audience. In light of all the shocks that we've seen of late, of interest rates, of immigration, of tariffs, how is the regional economy faring, and how are our regional banks faring, in your opinions?
Well, I think if you look at the Kansas City Fed, the Kansas City Fed releases a number of metrics to try to help us see. A manufacturing survey, they do a services survey that is surveyed within the 7 states they serve. And I think what you'll find is really not unlike the nation as a whole, which is businesses will tell you we are feeling the impacts of tariffs, and that uncertainty about where will that end up is causing us just to wait and see in some instances. When you look at ag is under pressure right now. Again, from the ag surveys that are led right out here out of the Omaha branch, to see that we're beginning to see more borrowing come into the ag sector because input cost and the commodity prices that are affected by some of this. We see in the labor market some of the same things that we see nationally, which is businesses are reducing the number of job openings, again, I would say because of some of the uncertainty around that. So when you talk to people, they will say the economy's doing fine, and that's probably true when you look at the nation as a whole. No one thinks recession is coming to their business, but they are watching carefully to see how many of these policy changes play out and where they should be positioning themselves.
Yeah, I agree with what Esther's saying. The one thing I would also add is that we talk about the tariffs will slow the economy, and it will. And the tariffs will have inflation impact, and it is, and it will. But that's one part of it. Right now, I think the economy is building towards a bubble. There's an enormous amount of liquidity. I mean, I saw a number here about a week and a half ago. There's $7 trillion of cash sitting there waiting for the next opportunity, and we're already spending hundreds of billions of dollars on AI and things related to that. And that area is bubbling over. And so when you see that, eventually you will have a correction. And how big the correction is will depend a little bit on how long and how big we allow the bubble to go on. And that's a great challenge. And I really am worried. And I think the Federal Reserve should speak out on that more than it is as we go forward from here. So there's great uncertainty around it, and there should be.
Colin? We can open things up here for Q&A, so if anybody's got questions, so we got microphones coming around.
Question right here. Hi, thank you very much. You referenced uncertainty, regulatory uncertainty. I wanted to ask you questions, pick your brain about messaging. How is it that what are your thoughts, I guess, is my question, on messaging to make the consumers of the Fed services, who are ultimately all of us, better understand the short-term and long-term effects of various policy solutions? Everybody in business operation of some sort is sophisticated in their own business operation. There are very few people who are sophisticated in yours. Has the Fed historically or considering speaking to a way of better communicating the effects of various policies?
Boy, I think how the Fed communicates is a big topic of conversation within the Federal Reserve. But I think to your point, their messaging has been primarily focused to markets, because markets are the ones that are, in fact, you saw last year, the Fed cut interest rates 100 basis points and mortgage rates rose. The 10-year rose. And, I think most people expect if you're cutting interest rates, I will see it in my credit card statement. I'll see it somewhere around that. So this idea of communicating to the general public is important. One thought I have on this, and this is where this dual mandate conversation I think is so confusing to the public. The Fed is able to directly affect inflation. When it tightens, when it raises that interest rate, it affects demand, it affects the cost of borrowing, designed to bring that down. When the labor market gets out of whack, like we see now, there's some curious things going on. The fact that the unemployment rate has stayed steady, and yet we have fewer job openings. We see supply of labor is less. The Fed can only indirectly affect that. It's not as if when you lower rates, suddenly people should expect that jobs will be added. But it has historically been, I think, very difficult. It's one of the reasons I've been an advocate for how the Fed is structured. As a Fed president, it was my job to get out in that region and be talking directly to people about this is how the mechanism works, this is how policy works, it's what you should expect. But I would say it's not very well developed in terms of how they target their messaging to the public. And I think to Tom's point, I don't think most people make the connection between the fact that we have a $2 trillion deficit that has to be financed and what the Fed does. Because what you will eventually see is the interest rates will be much higher regardless of what the Fed does.
Can I just say one thing for the consumer? I have argued for years that we do not teach economics in high school, and it's not a mandatory course in college, and that's a mistake. Monetary policy and fiscal policy and how an economy works affects every human being on earth. It's one of the most important things that will define your future in terms of your knowledge of it, understand how it affects you, and yet we don't make it a central theme in our education process, and that's unfortunate. It really is.
I'm an economist, so I'm obligated to agree.
What would you say are some of the challenges or circumstances unique to the Kansas City branch that you faced during your time as president?
Well, yeah. I mean, I guess I'll throw out a couple I can think of. When you have a region that has attributes that are unique to it. So for example, the Kansas City Fed region, heavily driven by ag and energy economy through transportation networks, given that we're in the middle of the country. And so trying to understand how economic conditions flowed through that, you would often find, when I sat at the FOMC, it was probably true with Tom, the kinds of things you would hear coming from the different regions would really reflect what is it that is driving your regional economy and how you see things unfolding. And the same, as I mentioned earlier, with the banking system. We had a very different banking system in that 7-state region. We didn't have, one of these systemically important institutions. These were community banks. And so understanding how regulation was flowing through to affect how those banks were able to extend credit in their communities was sort of a unique aspect where we would often focus our attention.
Let me give you an example that I think will resonate. In the great financial crisis in 2008, the markets froze up, and it was incredible. And some of the largest companies in the United States and in some of the largest banks were caught in that. And the centralized system, the Washington, New York group, immediately began, we got to find solutions for our banks and for our companies. And there's a list of programs that came out to provide liquidity into that market. And we're sitting in Kansas City, and we have major important regional companies that were also feeling the tight. In fact, some of the larger banks were saying to them, we can't lend to you, we're tight. And we're saying in Kansas City at the FOMC meetings, you better start thinking a little more broadly here. We know what we're doing in the Midwest, and we know this isn't going to work for them, for our companies. And so let's get this program figured out. So you can't imagine the importance of a regional bank in making sure that that region is treated the same as the ones that are large and too big to fail. And it is politically difficult, and it is operationally difficult just to imagine that they're going to be able to think broadly enough. And so it's huge in terms of its meaning. And
it happens every time there is some kind of crisis in the economy. It happened during the pandemic, where the immediate answer is to fix sort of what I call the Wall Street nexus of where money flows. And you have to really say, wait a minute, there are businesses in this region that, again, remember, most of the employment in this country is not just out of big companies that we all recognize. We have about half of the employment in the United States comes from small business. And so when you're in a region where small business is so important, I think Tom and I both had the experience of having to raise your hand and say, wait a minute, we need to think about how the economy from grassroots up is going to recover from things like this.
Question here, thank you for being here. Curious with how much data the Fed looks at. You mentioned jobs. I'm more interested in spending and discretionary spending and the buy now, pay laters we're seeing today. That's, it's grown so much that I'm curious how the Fed considers that in the data, and more in general, a trend like this and how the Fed considers that in general.
Well, basically, what you're talking about is consumer leverage. And we know when you have a strongly growing economy and it's leverage driven, so you expose the consumer to the downside of that, it's a two-edged sword sort of thing. And so you do think about it. And what you try and do is say, let's make sure we don't suppress interest rates to the extent that you subsidize borrowing and you subsidize spending, and the long-run effects are enormous. I remind people when we talk about things going on today that the United States of America, since 1970s, early 71, 72, the United States of America has consumed more than it has produced in nearly every year of that half century. Think about it. And so how do you do that? Well, you lever up. And one of the things that you will note, and what's going on again, when we had the crisis and subprime lending was running rampant, the blowback on that in terms of the hardship was enormous. So right now, I'm watching, and others are helping me watch, I should say, the fact that the second mortgage business is starting to grow pretty dramatically. Now, what is that? Well, I have a house. It's leverage free. It's paid off. But let's say I want to buy more. I want to help my kids. I don't care what it is. It could be a very good reason, or I want to go on vacation. And you basically say, I want a second mortgage, or I want a new first mortgage, or if I have a small mortgage, I want a second mortgage. You're leveraging up. And leveraging helps stimulate the economy as it's doing right now. But you also have to think about when and how do I pay it back? And that's what I worry about as I watch the consumer today.
Yeah, when you're in a consumption-led economy, the incentives are to try to make sure that's such a big part of how the U.S. Grows its economy. And so leverage is an important, and has been an important part.
Well, thank you so much. That's all the time we got here, so please join me in thanking Kyle Arganbright, Esther George,